Regulators are jumping to infiltrate markets, impeding growth and free trades. That's the premise of a new report by the International Chamber of Commerce. Here to speak to me about the findings is Kah Chye Tan, Chair of the ICC Banking Commission. Well, Mr. Tan, how important are the 2014 Trade Register report findings and how surprising?
When we first started, the register was really there to address regulatory capital matters. But increasingly, we find that the register is being used as a tool to help alternative investors to invest in a new asset class. And in this case, it's trade finance.
So do you think the cacophony of regulations are stunting growth in Europe?
The jury is still out. There is definitely room for a more reflective, a more accurate set of regulations to govern trade finance. I will say that, in the last 5 years, we have seen many proactive changes being put in place by the regulators. But like everything else, Jenny, there is always room for improvement.
Well, 60% of respondents felt the lack of harmonisation of compliance standards created problems. So would you say transparency hinders competition?
It does. It creates a very uneven form of competition. So from that perspective, yes, it does hinder growth, and actually it can go against the very objective of the regulations, that is to promote risk management. So giving you a quick example, the regulations has improved such that there is no longer a 365 days floor for letters of credit as a product, but that is not being consistently applied across all trade finance products, and definitely not consistently applied in all countries.
So would you say then that there's a call for regulations to be standardised throughout world markets to create more of a fair playing field?
I think the regulator's job is very tough. On one hand, we want simple regulations. On the other hand, we want it to be sufficiently granular to differentiate the risk profile. I do believe that simplicity and standardization will benefit the industry as a whole. I think there's a lot of feelings in the marketplace today that the regulations today is looking more and more like a black box. It's difficult for people to understand. When you have a set of regulations that's difficult for people to understand, no matter how good is the intention of the regulations, you run the risk of the means and the ends getting mixed up. The bankers chasing after the means rather than chasing after the ends. So simplicity is important.
Well, there's certainly a feeling that more transparency equates to less profits. So who benefits from more transparency?
Actually, I think more transparency will promote a more sustainable form of banking in the medium to longer term. In the shorter term, yes, as with every change, it will create some discomfort. And I guess that's the reason why people think the transparency result in lower profit. But that's a very inappropriate short-term view. In the medium to the longer term, the transparency actually builds a much more robust banking environment. Yes, maybe profit will go down for the banks, but you know what? I think there'll be more players, more companies will benefit from it, and there'll be more opportunity for us to finance trade.
So the ICC's report suggests that banks financing trade should be less stringently regulated than other areas of finance. Why is this?
I wouldn't say it is less regulated or more regulated. I think it's a different set of regulations that is needed. There is a general market acceptance, and the data from the trade register further reinforce that it is a very low risk product. The loss history can be as low as 0.03%. It's a fraction of AAA corporate bonds default rate. To manage trade finance as part and parcel of the broader corporate range product, we run the risk of the law of averaging. All right. When you put trade finance with more or less risky products and you draw an average, say the average AVC as an example, some products that are higher risk is going to benefit from an average AVC. Some products that is lower risk, as in the case of trade finance, will not benefit from it. In fact, will be disadvantaged by it. So for that reason, I don't think, it's a case of whether we are asking for more favorable regulation or less favorable regulations. We are asking for the right regulations.
So trade and export finance is a significantly low risk banking finance technique, you said. So where are the high risk areas and do they give more profits?
All else being equal, the longer maturity transactions would have a higher risk. All else being equal, A product that is further and further away from the real economy will have a higher risk. In the case of trade finance and export finance, these are relatively short-term products. These are products that support the real economy.
Well, I want to take a little look now at the Basel Accords, and what are the problems, would you say, with these?
What is needed is greater differentiation by the different risk profile of the different banking products. Credit card is 30 days, housing loan is 30 years, trade finance is 90 days, a project finance is 10 years. Trade finance has nothing to do with credit derivatives. We need to put the various products in its logical buckets and come out with a logical set of regulations to manage each bucket. The law of averaging is a case of oversimplification.
Okay, so finally, what's the key to driving liquidity in international trade?
An active dialogue between the regulators, the bankers, and businesses, the importers and the exporters, is very important. Only through an active tripartite dialogue between the regulators, the bankers and the businesses that we will come up with the right set of regulations, especially in the case of liquidity. Trade finance is as short as 90 days. The average is between 90 to 100 days. There's current sets of regulations that requires 50% of funding to be long-term. To finance short-term 90 days, 100 days trade transaction would be too onerous, and we will end up be charging the clients more than what is needed. And that's the danger that we are trying to avoid.
Mr. Tan, thank you.
Thank you, Jenny.